Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I always say that beginning thing, it's like off of rote memory. Looking at the comments, there's a comment here I want to answer. It's about uranium. It says, is this the correct way of approximating a company's future price of uranium per pounds? So what I did is I calculated the market cap divided by the pounds in the ground. It says, if we assume that the company gets into production in this cycle, shouldn't we use a profit per pounds of uranium? For example, let's say that the spot price goes to $100 a pound and the producer gets a contract for $70 a pound of uranium. If we further assume that the total cost of producing uranium is $30 a pound, this gives a profit of $40 per pound of uranium. Then multiply that with the size of the deposit and divide it. So what you're calculating is the profit of the company. What I'm looking at is what is the dollar that I'm paying per pound in the ground. In commodity companies, if you can find a company that's a high cost producer, what that means is you want a company that is not profitable, that people think is a long shot. And what they're going to do is they're going to price that company cheaper than other companies. We can use any metric we want to value that company. So we can look to see what the profitability is, but what are you paying for the price of the company? How are you valuing that company? Now, there's different ways to value it, and companies that have greater profit margins are going to carry a greater dollars per pound in the ground. Investors are going to bid them higher. So the companies that are more successful, the companies that the market perceives to be more successful will give them higher valuations. Their valuations need to be indexed to something. So if you have a large market cap, that market cap doesn't really mean anything until you index it to something. So if you index it to how many pounds they have in the ground, you can kind of say, well, you're paying this much for how many pounds they have in the ground. That is a good way to level load the playing field to make sure that you're valuing everything the same. Another way that you could say this is the companies that have the highest valuations are the ones that the market has the most confidence in. That's another way that you can make that type of analysis. The way that I look at some of this is we're not looking at the dollars per pound on an absolute basis. I mean, you can do that, and you could say your market cap per dollar uranium pounds in the ground is roughly X, Y, or Z, right? That's a way you can look at it in absolute terms. What I'm looking at is what are the relative terms? What is on the cheap side? And what companies have the greatest potential to change that dollars per pound in the ground? That is the investment opportunity. It's not that it's the cheapest. We don't want something cheap just to remain cheap. We want something that is cheap that has the potential to become better priced. For example, Bannerman was something like 66 cents a pound or something like that. And they're also quite they're quite far along in the development of their mine. They've got maybe 3 or 4 years to go to build it. And they could, if they were successful at getting the money and they were successful at creating a mine and they could negotiate something, that valuation could dramatically change to the upside. That is all upside on top of a uranium price moving higher. That's your leverage to the price move. That is management creating value for shareholders. So I like Bannerman because it is valued like it's not going to make it. The market does not think that Bannerman will make it based off of what the dollars per pound is. But I think that Brandon could pull it off. So maybe it can get priced up something like to a Paladin Energy where it's like $5 or $6 a pound. If it gets priced to a $5 or $6 per pound basis, I'm going to use 5.5. I'll cut it in half, all right? And they're at 66 cents. 5.5 divided by 0.66 is an 8 times price move. What I am saying is that their dollars in the pound or in the ground could be valued 8 times higher if they are successful at converting the mine into a successful producing mine. So they're going from 66 cents to $5.5 per pound if they can do that. And then you have the price move on of uranium on top of that. So that in my opinion would be a good spot, I think, to look, are companies like that. And a Global Atomic was also quite cheap, and they could potentially develop a mine and have a producing mine during this bull market. So those are a few that I look at, and those are what I use to value them, just to break them apart. The actual valuation doesn't really even matter. We're just looking at what does the market think of these companies and which ones are the cheapest. And which ones are the market, in my opinion, mispricing. And if we're looking at the ones with the greatest mispricing in the market, those are the ones with the greatest opportunities. And management, they're the ones that can successfully change those valuations. So those are the ones that I look for. Something like a Global Atomic, something like a Goviax, or a Bannerman, I think could be ones that could potentially go into production and change that valuation for shareholders. So those are the ones that I look at and try to overweight a little bit. The other ones that are priced more expensively, the market views a little bit differently. They view it with lower risk. They view the management teams perhaps better, and your leverage to the price move isn't going to be as much. So something like a Denison Mines or a Next Gen Energy or a UEC or UU, I don't think they're going to be as leveraged as much as something like a Bannerman, if Bannerman is successful, because they're already being priced like they're going to be more successful already. So it has nothing to do with the actual profit that they're going to have. We're just seeing what the market is pricing their pounds in the ground and having a level valuation playing field. So that's why I did it that way. You can do it other metrics however you want to. Usually the best in commodity bull markets, if you have a massive bull market, we're talking like a really big move in uranium or any underlying commodity, the companies that do the best are the ones that are the least profitable in the beginning. And then they go into being more profitable. The reason that is the case is when you look at the earnings per share, they go from a negative earnings per share, and people usually are like, oh, this company's not good. They don't make any money. Their balance sheet looks really bad. And then they sell them greater to the downside. I go in, I buy a lot of those companies because I'm probably an ultra bull on the commodity itself. When the commodity reverses, they go from the worst looking balance sheet to a balance sheet that looks very good. So the delta between their balance sheets of looking bad at the beginning and great at the end is the greatest. So usually the high cost producers under a very large bull market, where it doesn't stop at the high cost producers, it overshoots dramatically the price. And that's usually what happens in these high liquidity, high inflationary type environments where investors come in and put a bunch of money into commodities and drives the price far beyond the high cost producers. So your high cost producer at the bottom will be sold off the most to the downside. And when the money comes in and flows in and moves the commodity price higher, it has the potential to move that one the greatest amount to the upside. Because when you do your earnings per share calculations, you go from a very good number divided by a number that could be below zero, which is an infinite amount. If you have a low cost producer, which was always making money, and now they're just making more money, the delta between what they're making today and what they were making isn't as great as the high cost producers in most cases. It is a lower risk play, but I like to play the highest risk at the least risk time. So if the commodity looks like it's breaking to the upside, I go after the big volatile companies, the ones that looked really bad on the downside, and then they just explode to the upside. Also, you also get a bunch of short sellers in those. So they have to cover their positions, which adds to the buying pressure to the upside. And usually you get some ridiculous moves. So companies that are like that, I would say something like a Bannerman, a Goviax, a Forces Metals, Global Atomic. A lot of these African ones in the uranium sector, I think, are the ones that I like. Fission, I think Fission could be a good one that could go up to the upside. It's pretty well priced. It has a pretty good deposit. I think their management team's pretty good. I think that's a good one to look into, even right now. That's one that I'm looking into. It seems to be priced quite low in relationship to all the other ones, and I don't think that's. I think the market has it wrong. Put it that way. That's my guess. Maybe they have it priced right. Maybe they do, but I'll put a little bit of money on it. There's other companies too that I look at in other sectors, like fertilizer and stuff. IPI looks really good to me. Intrepid Potash. We've got a nice good bottom going right across. It's about to break to the upside. I've substantially increased my stake in Intrepid Potash. I had a big stake in Mosaic already, but those are my two favorite potash ones. I'm looking for the bounce. Another one that looks really good in home builders is Hovninian, HOV. The home builders, I think they're going to have a good run in America. And Hovninian, if we can break a certain level, that it's not there yet, but if we break above that, I think we could see a monster run like it did in the mid to late 2000s. We could see a similar run to that. So that's my take on that. This person says Elizabeth Warren and other Democrats in the Senate want to kill U.S. LNG exports. So this guy opened a small position in Tellurian. Betting against them. Yeah, I would bet against them too. So coming on down here, this guy says, I wrote my master's thesis on technical analysis of the stock market. So I love the charting videos. However, they would be greatly improved if you had provided the stock symbols. Oh, maybe you can't see them. Yeah, that's true on those. Also, you have looked at UNG. What a perfect cup and handle pattern. I don't know anything about Pantheon Resources. Someone's asking about that. I don't know much about Pantheon Resources. Right now, guys, I'm not going heavy into the oil area. It looks like we could potentially pull back. I like uranium. I've been looking at uranium. It looks like we're trying to put in a bottom here. I'd like to see some more upward movement. I do like the royalties. I like Sandstorm Gold. I like some of the gold area. IPI, Intrepid Potash, I like a lot right now. That would be one that I would be looking at right now for myself. Sandstorm Gold. There's a Karora Resources, another one that I would look at. Karora with a K. That one looks pretty good. I would be holding off on oil. I would hold my money back, see where this bottom is. If we start to move back up, then I would buy into that strength. That's how I would play it. And just watch the dailies on that that I release every morning. Look for it. There was another one, a company called Altius Renewable Energy Royalty. That's an interesting one because they've got a bunch of revenue coming, and they're going to be cash positive in 2022 this year. They've got a bunch that are operational, and then they have a bunch that they've got that are going to be operational this year and next year. So they've got a wide array portfolio filled with royalties against renewable energy, and they get a percent of the revenue, like 2.5% of the revenue, 3% of the revenue, based off of a certain power generated. But I don't know what the maintenance costs are for that generation of power. I would think it's pretty low. So we're just playing the electricity prices at that point, right? And if we have problems in natural gas and we have problem in oil and potentially coal, the fossil fuels, it's going to drive electricity prices higher. If you have the renewables in a royalty where you have none of the input costs or any of the maintenance costs they're not on you, you just have a royalty of whatever power is being generated, and the electricity prices go up, that could be a pretty good bet. So I've been adding into the Altius Renewable Energy. It's ATRWF is the ticker symbol that I've been kind of buying. It's been quite low. I averaged in a little bit, and I bought in all the shares under $8. I've been kind of loading into it because I do think electricity prices are going to go higher under an inflationary period, which means higher maintenance costs, higher fossil fuel costs, higher input costs, higher employee costs, et cetera, et cetera. So I think electricity prices will probably go up. And if that's the case, then having and owning this this royalty and getting royalties based off of power being generated from things that they already loaned money in, and now they're just getting the revenues. I think that's pretty smart. I think. I mean, so that's one thing that I find kind of interesting is that royalty. It looks good, and even the other royalties are all good as well, like copper royalties and all that. So I'm pretty big on the royalty business, guys. I think it's a superior one, and I think I don't know. I just prefer it over the mining companies. Some of the mining companies are going to do absolutely incredible things. I just don't know which ones. I'd rather just choose a diversified royalty approach and bet on the sector or the metal going up and getting that direct exposure. That's kind of how I view it. It says, hi, Andy, I have a very reliable source. Q1 2023, oil's going to go between $160 and $240 per barrel. I don't know if that's true or not. I do think that we're going to go far higher. I don't try to put price projections. I just know that we're going to go far higher. That's when the market gets really tight, is Q4 2022, Q1 2023. So that we'll see where the prices go, and we'll see where the prices go after that. If we see prices that go berserk to the upside for natural gas and oil, I think electricity prices will go higher. I think obviously home heating costs are going to go up, and we're going to have inflation because all this, oil's in the number one commodity. It's in a whole bunch of different products. So I do think that's going to go far higher, definitely. Says your final comments are platinum, and I appreciate your candor and realistic look at the markets. I don't know. Yeah, platinum. It's the best metal in my opinion for investment purposes. On a ratio basis, it's the cheapest. I think there's a lot of. It peaked in 2006. The production in South Africa. It's coming on down. I don't know if they can produce more of it. Maybe in the very short term they can, but long term, guys, I think platinum's done for in the supply side. I think on the demand side, there could be potentially a whole bunch of uses for platinum in hydrogen type environment. Are we going to adopt a hydrogen economy? I don't know. We don't really need to. We just need some cars to be hydrogen, and it's going to blow the price up because the mismatch and imbalance in platinum of the supply and demand could be quite dramatic. So I think, and the charts look incredibly good. I think to have some physical platinum is, I don't know. I think it's really good. I can't find anything better from a precious metal perspective. I also like silver. Silver's the number 2 commodity. Silver is an incredible way to play it as well. Looking down here, so I'm waiting for a pullback to add to positions. Sometimes that's tough because usually when I sit on money, I don't want to sit on it forever, and sometimes I don't pull back. And it's hard. So I end up cost averaging in slowly. That's kind of how I do it. And I'm like, I'll put this amount money in, this amount the next day, and whatever looks good at that time is what I go into. So what I do is I don't say I want X and then I put all my money in X. What I do is I say, okay, I've got money coming in. This is roughly what I'll make over this time period. And whatever's down at that time, I just keep buying whatever's down. Then once they go up, I don't chase it. I find something else. And if something else is down, I go buy that. So the one that I purchased recently is Altius Renewable Energy, Intrepid Potash. When it was down, I bought that one. Nova Royalty's been down. I cost averaging a little bit to that. Teuton Resources has been down. Sandstorm Gold's been down. I've actually been going into those type of companies here recently. I have not added to energy the past week or two in there. I've added to some uranium. I bought Uroy, Uranium Royalty. But I would add to Fission, FCUUF. Those are the ones that I would add into, and those look good. Karora Resources looks good. I haven't added into the silver companies. I'd like to see more of a bottom. I'd like to see some things start to move on up. So Sandstorm Gold, that one looks really good. There's Royal Gold looks good too, RGLD. And then all the other stuff, I don't try to, the oil's gone up quite a bit. I've been riding that one higher. And I've already got big positions, really big positions in those. So I'm not going to add into those right now. I definitely wouldn't add into them at this second. CRK may be one to look into if you want something that's down and is more natural gas heavy. So that's those there. We're getting about 20 minutes here, so I'm gonna cut it here, guys. Give me a thumbs up for the content. Subscribe to the channel if you haven't already. Leave in the comment section if you guys have any questions on anything. More than likely, I'll answer it through a video like this or something if I think everyone should at least hear my response. Otherwise, I'm just going to type it out to you. But yeah, thanks for listening. This is Finding Value.